All right, let's talk about the strategy of dividends, dividends from individual stocks, and why in the context of here we are in the third quarter of 2014, the S&P set a record in July. Why is this strategy going to be important? And there is a key to this strategy, and we're going to come back to what that key is. But what I want to do today is go through the math of dividends, because I think if you understand the math, you will see why this strategy is particularly important right now in this context. In our portfolio management, we have two types of dividend strategies. We do one for total return, and right now in this total return portfolio, we're in the dividend range of 2.9%. Plus, you want to get growth in the actual share price of the companies. And we also have an income strategy where the dividend yield is over 4. Right now it's about 4.1%. Now, this right here, this strategy right here, if you are within 3 to 5 years of retirement, this is something that you must do. You must have a specific program for your retirement dollars in order to get income from dividends, and you're going to understand why as we go through this math. Now, there are over 24 companies that we look at between the two portfolios, and we're constantly measuring things like the debt to capital ratios and also the debt to equity, but we also look at the debt to earnings, and in the earnings we do that in the form of EBITDA, right? So if you ever heard that term or seen this, what does that mean? It means earnings before interest, taxes, depreciation, and amortization. It's just a financial measurement that we use. So we're constantly looking at this and other things to determine when to buy and when to sell different stocks within these portfolios. Now, I will tell you there's much less turnover in the income portfolio than the total return, but I think the best thing to do is just to show you a typical company. So I'm actually going to Yahoo Finance. You can actually do this on your own and see. So I'm just going to pull up AT&T, a bellwether stock company. Obviously, it's been around a long time, and I just want to point out a couple things. Now, you can see here that the dividend is paid out at 1.84. 1.84. And we're going to go through the math here in a second. So that's what they pay per share. If you divide the 1.84 times the current price, $34.56, you come up with a yield of 5.2%. So this stock is paying 5.2% in dividend. So let's go back to our board here. So the dividend is paying 1.84, $1.84, and that was a yield of 5.2. How do we get that? We divide this into the share price, and the share price was $34.50, right? Now, the interesting thing about AT&T is in the mid-90s, it reached above $20 a share, and it had highs in the 50s, but basically it bounced between $20 a share and $40 a share ever since that period. And right before 08, it actually hit 42, but then after the 08 correction, it went down to 23. So here's my point as it relates to this time period we're in right now with the S&P setting all-time highs. Our yield is 5.2% today at this stock price. If there's a correction in the market, which all markets correct, and AT&T corrected more than the 37% in the S&P in 08 overall, it was actually down a little bit more than 40%. But if we get a correction to where if we can buy AT&T instead of today at $34, let's say we're able to buy it in the mid-20s. Let's say we're able to buy it at $25 per share. What's the math? If the dividend stays the same, which it should, that's why we would buy a company that has stable dividends, not only stable dividends, but increasing dividends. 1.84 into 25, what does that equal? That equals 7.36. So the magic of math, right? By simply buying a stock at a lower price instead of at today's market, there's a correction in the market, we're able to pick the stock up at $25. Our dividend yield goes from 5.2 to 7.36. Once you buy this cost basis, no one can take it away from you unless you sell the stock. Remember what I said earlier, we have more turnover in the total return portfolio than we do the income portfolio. In this strategy of the dividends, remember I said there's a key here. There's a key to this strategy, and the key is you have to be ready and have dollars available in order to buy these companies at the lower price. If you want to get an increase in yield, and not all of the companies are paying 5.2, as I told you, the average is 4.1, but there are companies that are paying 3 and 4 and some 5 and 6. But if we are able to pick those very same companies, and again, we're looking at their debt to capital, their debt to earnings, we're looking at all these to make sure they're still safe and have stable dividends. But if we can pick those same companies up just because they are on sale, right? They're on sale, they are a better value, and for doing that, we increase our dividend yield to much higher by 2 percentage points. That is important. That is important if you're within 3 to 5 years of retirement. To have a portion of your retirement savings cranking out that kind of income, right? If we can position this to where we can get consistently 5 to 7% on a portion of your portfolio, regardless of what the stock price does, right? If we establish this basis at $25, over time, AT&T can still do its ups and downs. Does that change our yield calculation? No, because our basis is still 25. So it can run up to 40 and it can go down to 20. We don't have to panic because we're cranking out this yield year in and year out. And doing this in this interest rate environment, right? Here's the 10-year Treasury. We're sitting here today in the 250-ish range. Now, we believe interest rates are going to go up. The Fed is telling us they're going to go up. We don't know if they're going to go up to the 4% level, the 6% level. You can do all kinds of retirement income planning if you can consistently get this middle range of 4 to 6%, but we can't rely on this level for income. If you're working today, you're working for income, you spend your income. The same thing happens in retirement. You want to spend income in retirement. To have this level of income coming in from dividends, regardless of what interest rates do, is critically important to how you enjoy your retirement. But the whole key is you have to have money available and you have to be ready in order to take advantage of these. So I wanted to quickly go through this math. I hope it made sense and I hope you see it as an important strategy. Thanks for watching.